Rajesh Bhatia. He's Chief Investment Officer at ITI Management on the show to try and understand how does he think about the landscape currently. Rajesh, great having you. Thanks for taking the time out. Rajesh, when we spoke midway through the year, you were relatively cautious on select aspects of the market. As we hit 2025, it does seem that the caution was well warranted. The question is it time to be even more cautious now? Because the overarching view on the street seems to be that it's a year for discipline and not a year for gains.
No, Neeraj, I would concur with that view that it is the year to lower your expectations of returns. We have done extremely well as a market over the last 4 years. In fact, even longer than that. We had a fantastic run from March 23 to September 24. 6 quarters of continuous rise in the market. The breadth of the market was excellent. It was really a fantastic bull market. Since then, we have seen some softening thanks to the slowdown in government expenditure. We all know that. And that has definitely hit the corporate results, corporate slowdown. And therefore, I think that's what is the continuation of that we are seeing. The risks have come from, apart from the slowdown in government expenditure, which has slowed the economy, has also come from the election of Trump as the president, because it brings a degree of uncertainty in the global environment, especially as it relates to what happens to the dollar, what happens to interest rates, what happens eventually to inflation and risk appetite, and so on and so forth. So there is some uncertainty that has been brought about by the election of Trump. And I think what people are looking forward to is this rebound of government expenditure, which can ameliorate our slowdown or help our slowdown. Because if you look at our GDP components, C, consumption, plus G, which is government expenditure, I is investment, export minus import. What is working, or what was working, is really G. Consumption is slow. Private investments, nothing much to talk about. It's good, but it's not going to drive your growth. Exports, we're in a global slowdown, so don't expect too much from there. So the government expenditure really was the one which was driving the GDP growth of the country. So for the moment, we are looking forward to the G bouncing back, and that's really where we are.
Mr. Bhatia, very good morning. Tamanna here, and glad to speak with you here on NDTV Profit. In terms of government expenditure, is that the only sort of missing brick, and is that going to be enough? I'm just wondering how you're seeing at corporate performance ahead of Q3. We're going to get into the thick of it. And are you penciling in or preparing for another disappointing quarter?
So I think you've had some previews come in from banks and some consumer companies. And of course, I think the primary reason why the market was down yesterday was not as much about the concern about the virus, but the fact that corporate results could again be a little anemic going into Q3. And I think people are still looking for visibility for when does the economy revive, because like I pointed out, they're looking forward to government spending. Now, with the rupee being where it is and global interest rates being where they are, the 10-year treasury in the US, it reduces monetary flexibility. You cannot reduce interest rates dramatically. To some extent, it may reduce even fiscal flexibility. So that is the challenge that we are kind of going through. Whatever, all said and done, it will take time to repair. Even if we have to kind of repair some of that slowdown, probably people will wait, or the governments also will wait, policymakers will wait for the Trump effect to kind of be known before they start pushing the pedal. So my sense is that even if there's not too much of a bad news regarding Trump, I think this slowdown will take some time to kind of work its way out. So that repair will take some time. And that's why I think you should keep your expectations from equities low, at least in the first half of the year.
First half of the year, keep your expectations from equities low. When you're looking at the equity basket, I'm just wondering, Mr. Bhatia, what is the kind of allocation that you see? Would you be taking some profits off the table, sitting on cash? And if you are looking at equity allocations, then to what extent are you looking at key sectors, and which key sectors are those?
I still believe that we are in a bull market. So this is really a consolidation in a bull market. So, and I don't know how much is the price-wise correction that can actually occur. Maybe there's a bit of a time-wise correction that happens in the equity markets. And of course, we have seen some part of that already. So I'm not sure whether you want to take a very, very aggressive cash call unless you're that type of an investor. For a long-term equity investor, I don't know if you need to take a very, very aggressive cash call. Keeping some cash is always helpful. But if you're a long-term investor, my sense is that, you stay invested, but keep your expectations low. Don't over speculate in this market, especially on the long side. So that is really where what I would think as to how you deal with this period of consolidation.
Rajesh, could the markets correct further? And by correct, I don't mean 1-2%, but significantly, simply because one, there is uncertainty, two, if the earnings isn't the best, three, if the budget has something around tax, a bit of an uncertainty there. There's also this new virus thing, and if the tariffs go up in the US, then it's inflationary and we might actually see rate hikes too. So while everybody's talking about when the markets will recover, I'm asking you the converse. We've corrected. Can we correct about 10% more? Or is that not the base case?
Well, not really the base case. Maybe, another 7% is, it can always happen. Because if you are saying that there's going to be a more than a 10% correction from here, what you're saying is that from the top, you will have a 20% plus kind of a correction, which is like really a bear market. So I'm not sure whether we are going into a bear market unless there is change on the macroeconomic front. So that is where the uncertainty is. Do the macroeconomic variables change, dramatically? We have a very, very stable macro. So my sense is that anytime we have a bear market, those are usually caused by macroeconomic events where the stability becomes instability. We are not seeing anything at this moment which says that we are going into a macro unstable environment. Our macros are quite stable. So unless incrementally, this is just a valuation correction and a slowdown correction that we are seeing. And of course, we have an opportunity to kind of climb back up as soon as the government expenditure, etc., and is restored. And once we have greater clarity on what Trump will do. So that's really my base case. Unless macroeconomic variables change dramatically, I don't expect a bear market in India.
Okay, no, fair call. So that kind of correction not seen, but 5-7% from these levels not ruled out entirely. The other question is, Rajesh, do you reckon that there could be outliers on the upside? There is a lot of talk of how defense names will be in focus because orders will get bunched up in Q4 and there could be upsides there. There is talk of how pharma, despite not being in the Biosecure Act, could actually see a bit of an upswing by virtue of the fact that, if the initial signs of the US-China hostility is evident, is anything to go by, there's going to be a lot of China plus one in the next 4 years, and therefore you look at all critical areas which might actually do that. So are there going to be telltale winners independent of what the markets or the headline indices do?
So Neeraj, you're absolutely right that this is going to be a little more stock-specific market. Look, the breadth that we saw between March 23 and September 24, that at least that breadth has narrowed. So, when you go into a correction, instead of when a bull market, you see a very wide breadth. But in a bear market, you're more likely to see, or a declining market, you're likely to see the breadth kind of narrow. But as far as difference in and pharmaceutical is concerned, I don't think the starting point of valuation at this moment is, compelling. Of course, the narratives are very good as far as pharma or defense is concerned, but I don't think that the stock prices are reflecting value at this moment. They're still slightly what I would call expensive stocks. So the narrative is multi-year, no doubt about it. But my sense is keep your expectations low.
Rajesh, I'm just wondering whether, going forward, what are the big factors or landmarks that you're seeing where you can see a turnaround? You've said earlier in this interview that hang in there for the first half of the year. What could change by the second half of the year in that sense? I'm just wondering where those silver linings are or where those positive triggers possibly are.
No, you raise an interesting question. One is, I think the market will want to see what are really the policies of Trump. And I think the 20th Jan event is a pretty significant one. So I think market will take some time to digest. And if it is not as as fearsome as people predict, then I think definitely that could definitely help our cause. Second would be the budget. My sense is that this is a time where the government demonstrates whether it is favoring macro stability or whether it wants to go for growth. So if it really pushes the pedal on expenditure and tries to kind of revive the economy, that I think would be second catalyst that the market would look for. And if both those events are favorable, in fact, yesterday there was a Washington Post article which said that Trump tariffs are not going to be as severe as expected. And of course, Trump has denied that news. But if that were to be the case, and then the Indian government starts spending and is focused on growth, those are two events that I think I would watch out for. And that will give me a clearer direction that now the bottom is made and the markets are ready to bounce back again.
Okay. Okay. Rajesh, the conundrum when I think of things is technology. Simply because while banking would be update-wise and the economy grows, you probably see banking come back. If it doesn't, then you see banking languish. Technology is a bit tricky in that the valuations are not necessarily mouth-watering. We're coming in a year wherein maybe budgets get finalized, but still a lot of chatter around AI-related business losses too. Who knows? If attrition was an issue in the 2 years ago, it's AI currently. Where are you on this argument of Indian IT services? Are they good to have in the portfolio? Are they avoids in the portfolio? What would be your stance if you are allowed to not necessarily match the index which you might have to as a mutual fund?
So the expectation from IT is that growth rates will actually start to accelerate.
Accelerate. Okay.
Accelerate. The reason for that is that people believe that what does Trump want to do? He wants to cut corporate tax rates. He wants to raise tariffs. He wants to deregulate businesses, and he wants to stop illegal immigration, right? Corporate tax cuts and deregulating businesses. In fact, I read somewhere that just the deregulation of businesses will mean $4 trillion of mergers and acquisitions. Now, that's definitely going to spur banks, apart from the corporate tax rates. Banks are a very large spender in the IT category. So the expectation is that if the US economy revives and in fact accelerates, because that's what Trump wants to do, then Indian IT companies, which 60 to 70% of their sales come from the US, are likely to benefit because that will now act as a tailwind. The improved economy of the US will act as a tailwind to Indian IT services companies. So the expectation is that will help accelerate the growth rates of Indian IT companies.
TCS taking it to the chin ahead of its results this morning, but look at the kind of recovery in the Bank Nifty. That's definitely something to take heart from. Thank you so much, Rajesh, for speaking with us. Rajesh Bhatia, Chief Investment Officer at ITI Asset Management, joining us today on Talking Point.